All right, so I want us to do a quick analysis on the US dollar, Canadian dollar, using both candle signs, market structure, and supply and demand at the same time. So this is the monthly time frame. And what I can see right here using candle signs is price made this high, this low, which led to this high, which led to this low, and this low has been taken out on the monthly. So if this low has been taken out, I'm looking for supply and demand zones of this monthly. Right here, I have a demand zone, and right here, I have a supply zone. If you do not know what supply zones and demand zones are, you can check my channel. I have explanations about it. You'll see it there. So with this low taken, I'm expecting price to do one thing. It's currently in the demand zone, and if it does find like credible reasons to push up, then we'll start to see price do this until it comes back here. This is how we treat supply and demand. That is on the monthly. Now, because I've used candle signs, I no longer need to look at the weekly. I'll dive straight into the daily. I'll apply the same technique right here. Applying the same technique right here is where I get to get myself, real good. Now, this is where I would also call in the Fibonacci tool, Fibonacci retracement tool, or you could do that on the monthly. All you just do is you pull out your Fibonacci retracement and you draw it out right there. So this is my Fib, and from the low to the high. By the time you dive into the daily, you're looking for discounts and supply, right? You can see the demand zone is in the discount, in the premium, the discount zone, sorry. This demand zone is in the discount and the supply zone is in the premium zone. Up next, we're going to look out for confluence on the daily. So what are the confluences we're looking for? What do I mean by confluence? We're looking for demand zones in demand areas on the daily. So we have this clear push. This is where a clear push started from. And then this is a demand zone on the daily. That was the wrong color. And then for the supply zone, let's look at the leftover possible confluence we have. So we will draw this. Now, this is where it gets quite risky, right? This is where it gets quite confusing. This is supposed to be a supply zone on the daily, but we have one problem. If you look right here, you'd see price has already mitigated that zone. Though not much, but price has mitigated that zone. Hence, that zone is no longer valid. Per se, it's no longer valid all that much. So I don't like to leave zones like this. I like zones being completely fresh. So in other words, I would rather take this zone right here as my reason to watch the market, which is this particular candle on the vertical line. Hanging on my vertical line right here, this one. So now I have a daily reason to trade. Now, if you're trading daily time frame, all you're waiting for is you're simply watching the market. And you're waiting for this low to be taken. You're waiting for this low to be taken and price comes within this zone. And then you're waiting for the high created. You might create another high before it does it or whatever, but you're waiting for those highs created to be taken and price retracing to test. And when you see price heading away from that area, you can then start trading for the equilibrium or even the demand zone itself, the supply zone itself. So this is how you trade the US dollar CAD in a short period of time.